In 1998, a car parts retailer began doing something quietly radical. Not a new product, not an acquisition spree. It simply started buying its own shares and destroying them. Year after year, decade after decade, in good markets and bad. Today, that company has retired roughly 90% of itself. 9 out of every 10 shares that once existed are gone, and an investor who simply held has watched their slice of the business multiply many times over without buying a single additional share. The company is AutoZone, and it is the purest example of what this channel calls the reverse machine. Welcome to Quiet Bull. A previous episode introduced the denominator, the idea that a share is a fraction, and that companies which print new shares make every existing fraction smaller. This episode is the mirror image, because the denominator moves in both directions. When a company reduces its share count, every remaining fraction grows. Same arithmetic, opposite machine. And over long periods, the direction of that bottom number quietly separates two entirely different kinds of investment. The mechanics are simple. A company with spare cash goes into the open market and buys its own shares the same way any investor would. But instead of holding them, it retires them, cancels them. The shares cease to exist. Nothing about the business changed in that moment. Same stores, same products, same profits. What changed is the number of pieces the business is divided into, fewer pieces, bigger pieces. Every shareholder who did nothing now owns more of the company than they did the day before. Now run that arithmetic over time, because this is where it becomes remarkable. A company that retires 8% of its shares each year will, in about 9 years, cut its share count roughly in half, which means earnings per share can double even if total profit never grows at all. Combine a business that grows modestly with a share count that shrinks steadily, and the per share numbers compound at a pace the headline numbers never show. Dilution is a silent charge on holding. A well-run buyback is silent interest earned on it. Back to the car parts retailer. Since 1998, AutoZone has spent roughly $39 billion buying back stock, retiring more than 150 million shares and shrinking its count from around 150 million to under 17 million. That is a reduction of about 89%, close to 9% a year, sustained for more than 25 years. And here is the detail that matters most. The machine was funded by the business itself. The company generates around $3 billion of operating cash flow annually, selling brake pads and batteries, and it simply kept feeding that cash into the machine. Boring product, extraordinary geometry. The stock has returned several hundred times its original value since listing. Apple runs the same machine at a different scale. Over the past decade, it has retired roughly 40% of its shares. Hundreds of billions of dollars of stock bought and canceled. An investor who held through those years saw their ownership stake grow substantially by well over half without adding a dollar. When one of the largest companies on earth spends years making its own shares scarcer, per share results outrun company results quietly every single quarter. But the reverse machine has counterfeits, and the first is the treadmill. Many companies announce large buybacks while simultaneously issuing new shares to employees as stock compensation. The company buys on one side and prints on the other, and the share count barely moves. The buyback headline is real. The shrinking is not. The tell is a share count chart that stays flat for years while billions in repurchases are announced. That is not a reverse machine. That is a treadmill running fast and going nowhere, and the cash spent on it is gone either way. The second counterfeit is buying high with borrowed money. A cyclical business at the top of its cycle, flush with confidence, borrows to repurchase shares at peak prices. Then the cycle turns, cash dries up, and the company that spent its reserves on its own expensive stock finds itself fragile precisely when it needs strength. The American airline industry spent most of the 2010s doing much of this, directing the great majority of its free cash into buybacks, and entered the crisis of 2020 with thin reserves. A buyback is a purchase like any other. Price and funding still matter. The machine only creates value when the shares are bought sensibly and paid for with cash the business actually produced. So here are the 4 checks for reading a buyback, mirrors of the 4 checks for dilution. First, does the share count actually fall? Not the announcement, the count year over year. Second, is it funded by free cash flow rather than debt? Third, is there price discipline? Is management buying steadily or chasing peaks? Fourth, does it continue through downturns? The rare companies that pass all 4 have a name among value investors. Charlie Munger called them cannibals, companies that eat their own shares, and he advised paying close attention to them. A fair question, why not simply pay dividends instead? Both return cash to owners. A dividend pays every shareholder now and is taxed now. A buyback concentrates ownership instead, compounds quietly, and lets each investor choose when to realize the gain. Neither is automatically better. Dividends impose discipline on management. Buybacks offer flexibility and deferral. What matters either way is the same underlying habit, a business that produces more cash than it needs, run by people who return the excess rather than burn it. Put the two episodes side by side and a portfolio geometry emerges. On one side, the printers. Young companies funding a possible future by issuing shares. High ceiling, ongoing dilution, generally sized as small satellite positions. On the other side, the cannibals. Mature businesses retiring shares year after year. Lower drama, steadily growing slices, natural candidates for a portfolio's core. An investor does not have to choose one world or the other, but knowing which machine each holding is running and sizing accordingly may be one of the most underrated habits in long-term investing. So when the next buyback headline crosses the screen, the questions are already loaded. Is the count actually falling? Is the cash real? Is the price sensible? Does it persist when times are hard? The company's story lives in the numerator. The shareholder's outcome lives in the denominator. The market rewards patience. It punishes noise. Choose accordingly.